what I found was when I came up with list of powerful cities, I mean, you look at Salt Lake, they've just finished building a phenomenal train system. They're doubling the size of their airport. They're building an entire inland port that is larger than the size of Manhattan, right? Now, that's one example. But if I was to take like 10 of my favorite cities, and I'm probably not investing in 6 out of these 10, I just love their demographics, they're all doing great things. So the great things didn't lead to cities doing well. Cities doing well led to great things, right? And the opposite is also true. So one of my old-time favorite cities in America is Chicago, right?
Okay.
Phenomenal city, one of the great cities of the world, right? Not just of the US. But I tell people that it's a horrible thing to be investing in Chicago right now. And they basically say, why? And my answer is that great cities build great works. And Chicago seems to be consistently failing at building new great things. And the second thing is they've managed to get themselves into a situation, and there's a little bit of jest in this, but get this, and this was pre-COVID, right? Pre-COVID, I said Chicago and Cook County, they have three choices: bankruptcy in 2 years,
Mm.
bankruptcy in 3 years, and bankruptcy in 4 years. Those are their three choices, right? When you have only those three choices and nothing else is possible, why would I want to go and invest in these great cities? I'm going to wait until that bankruptcy happens. Stockton cleaned up its act. Orange County cleaned up its act. Chicago, being one of the great cities of the world, will clean up its act. I'm just going to wait until the bankruptcy before I add Chicago to my list. Because today, it's horrible. Chicago, and you used to have a D grade on these sites that rank cities and their stability. It's gone from D to F. They've lost $2 billion in 4 months. And now we're at the point where within a few, I think 2 quarters or 3 quarters, they won't be able to pay interest, just interest on their loans.
Wow.
So that has to be a full stop. If you cannot pay interest on your loans, you can only do one thing. You can create a Ponzi scheme and get more money so that you can pay the interest. And now you have new interest, so you have to get even more money. You know how that ends, right? I mean,
Yeah.
that's where it is. Chicago is months away from Ponzi scheme. So the first thing I look at is what asset classes are benefiting, right? What's happened, right? And I've always believed in public storage. But when I looked at public storage in the last 4 months, it hasn't done well. So I'm basically saying the data doesn't suggest that public storage is doing well, because all that new construction of public storage, some of which was not documented because it was mom and pop, is basically pulling down rents. Multifamily did pretty well in the last 4 months, but I'm a little hesitant because it seems to me that multifamily received a very large boost from the unemployment benefits. So I want to see how multifamily does for 2 months after the benefits expire. And as I'm looking at different asset classes, I'm looking at senior housing. I'm not so sure. Would you, if your grandma was in one of these big box facilities with 200 other aged people, would you leave her there, or would you just move her to your basement? But I think the biggest one is industrial. I keep saying this. E-commerce, 10% year over year is normal growth. 77% means that we've gotten 7.5 years of growth in 4 months. That growth is going to create supply shortages. We need 1 billion square feet of industrial in this country. Keep in mind, we're about to lose at least 500 million square feet of retail. Right? This is a swap. It's not a net new gain. It's a swap. Money goes from one place to another place, right? Retail is going to see an absolute meltdown. I don't think hotels are going to be as bad as retail. I think robotics is the greatest threat to our economy in the short run. I mean, it is incredibly dangerous. But if you think about it, I'm more bullish on industrial because of robotics. Think about it. Robotics give you incredible salary advantages. Now you have these thousands of robots that are running around 2 million square foot warehouses that are mostly empty, right?
Mhm.
It isn't my job to provide jobs for my citizens. I am not a politician, right? And I don't lead a city. It's my job to provide returns for my investors.
Right.
So from a social perspective, the rise of robotics is terrible for people, right? You can now have a 2 million square foot facility with only 100 workers,
Right.
where 20 years ago there'd be 5,000 people working there, right? I get that, But Aaron, why is that bad for industrial? It's good for industrial,
Oh,
because
yeah.
what we're doing is we're swapping space for people. And people, salaries are always more expensive than space. On a per square foot basis, if you can take 5,000 people and cut it down to 200, that 4,800 persons worth of saving is massive compared to the one-time investments in the robots. So the robots are here, they're here to stay, and it accelerates from here on. That's why I think industrial is a very powerful story. Does it have a colossal bad impact on our employment numbers in the US? Yeah, this is just the beginning. Yeah, one of the trends that I see is people are not just going to move from places like New York and Los Angeles to places like Phoenix or Salt Lake City. That's going to happen. But people are also going to move back to the suburbs. If you had to go into the office 4 times a week, you wanted to be 30 miles from work. But if you now have to go back to the office once a week or twice a week, you're going to be in a 50 or a 60-mile radius. So we had this movement back in the 2005, 2012 timeframe where people were beginning to go urban again. And then starting to 2016, it started to go the other way, where people were beginning to go suburban again. We started to see vacancies falling both in suburban multifamily and also in suburban office. And today, suburban office has the same vacancy as central business district, downtown office, right?
Wow.
So things have adjusted to the point where it's come a long way. There was a huge gap between the two, and it's now the same. Why? I'm not sure if people are following jobs or employers said, I don't want to pay $4 a square foot. I'm going to go pay $1.20 in a flexed industrial building in a suburb that allows me to open a location, right? So maybe they went first and then people followed them, or maybe people said we can't afford the central business district homes, so we're going to go out there again, and then the jobs sort of followed. But whatever happened, it happened. And so in 2020, in Feb, before COVID, we were already seeing this push back to suburbanization, and then COVID just massively accelerated the suburbanization. I think I'm more cautious than I was in Feb. And the reason for that is the premise of opportunity zones was the government is going to give you phenomenal tax benefits so that you and a bunch of other investors, highlight you and a bunch of other investors, are together going to put lots of money into opportunity zones. And because you put money in and they put money in, there was an all ships rising effect and lots of money was made. The area went up in value and everyone was happy and everyone made profits, right?
Mhm.
Nobody really talks about what happens if that premise wasn't true and you were the only one that ended up investing in that opportunity zone and other people invested in other opportunity zones, not yours, right? Well, in that case, you built a class A asset in a class C distressed area with low incomes and no population growth. Both of these ways of looking at this. So I'm very cautious about opportunity zones because opportunity zones really needed it's a good idea, but to grow it needed fertile ground. It needed the economy to be strong in 2019, and it was in 2020. It wasn't 2021. It's not going to be, and maybe not even 2022. So I think there's going to be some crash and burn stories that are going to come out of that area. But at the same time, I think that there are going to be certain opportunity zones where it's going to keep going. I just think that the outlook is not as bright as it was 4 months ago. Yeah, I feel like the developers, there's too many developers that people are giving money to that have never held assets.
Mhm.
So one of the things when people ask me, who should I give money to in opportunity zones? Neal, you only have one project. It's been years. It's been funded. You don't intend doing any others. My advice was make sure you only give money to developers that by their nature hold assets. Because 10 years is 2 recessions, maybe 3. If you give money to a developer and that developer basically gets fed up with the property, they're going to sell. Now, not only do you lose your profits, you also lose your tax benefits. Make sure you're giving your money to people that have asset management companies. They have employees managing assets, because 70% of developers don't manage anything. They're so in so much of a hurry, they don't even feel it. They give up that money to somebody else. They just basically sell empty buildings as soon as they're done with them, right? And which always strikes me as stupid, because like if you just filled it up, you'd make a lot more money. But their whole model is, no, I'm done with this. I don't want anything to do with it. Somebody take it off my hands, go fill it yourself, and I'll give you that extra delta for it. When a developer thinks like that, to
Wow.
be in bed with them for 10 years with you going in with one of the biggest recessions of all time doesn't sound the best opportunity out there. It could be. I mean, and one of the key things, Aaron, is, and people say, I was on the Realty Mogul podcast, and Jillian Hellman, Realty Mogul CEO, asked me, what keeps you up at night, Neal? We have all these deadbeat countries that have been in deep trouble for a long time: Japan, Italy, Greece. We have deadbeat economies in the US that are in trouble, parts of New Jersey, Cook County, and Chicago. We have all these places that were one domino away from just falling apart. What hasn't happened yet, but is a certainty to happen, is that a big domino falls. People are like, yeah, but Greece went bankrupt. The world economy didn't stop. Greece isn't, Greece is a fraction of 1%. What if Italy goes bankrupt? Italy is more than 1% of the world economy. The shock waves would be colossal. Cook County is a $500 billion economy. The economy of Greater Chicago is bigger than most countries in the world. So to me, this is not like Stockton or Orange County declaring bankruptcies. Those are localized events. This is something that shakes an entire country to its core. And if it happens with Italy, it's going to shake the Eurozone to its core. So to me, those dominoes are ahead of us. They cannot possibly have happened yet. But in the next 6 months, I think a major domino falls. There's 500 articles written about the fact that their options are basically about when they're going to declare bankruptcy and how to do that legally, because unfortunately they have issues with how to declare bankruptcy, right? But at some point, it just cannot happen anymore. And I mean, even economies like California, Aaron, I mean, the deficits that we're piling up month over month are just staggering. It's decades of deficits that we're piling up in months. So there's major challenges to deal with here, but I think major challenges mean major opportunity. I mean, right now we should be doing looking at buying foreclosures. If the foreclosures don't exist, maybe we should be doing lease options. All that stuff that worked back in 2008, it's going to start working in about 5 to 6 months.